Okay, the stacked limit order entry method. This is a more complex entry method for the objective divergence setup we just taught you earlier. We follow all the rules for qualifying the initial setup. Okay, now once qualified, we're going to measure the distance from the 50% Fibonacci retracement, which will give us an average position, to where your stop loss will be placed, which is above the high or the low of the divergence pattern, and use that number to determine your trade size. Okay, so again, basically what we're going to do is you're going to measure from the 50% fib, okay, and that's going to give you, you're going to take that and you're going to put it into your risk calculator, that number, okay, and that's the number we're going to use because that's going to be our average position. Now we're going to split that trade size into 3 limit orders, and we're going to place 1/3 at the 38%, 1/3 at the 50%, and 1/3 at the 62%. Okay, we're going to place our stop losses above or below the high or low of the divergence pattern. So our stop loss is the same. We're going to place our targets at the 127% Fibonacci extension. Now, if price retraces to the 38% fib, okay, it's going to bring us into the trade. It's going to bring 1/3 of our position in. All right, if it moves to the 50%, it's going to bring 2/3 of the position in. If it moves to the 62%, it's going to bring in the full position. All right, make sense? What this does is it allows you to take advantage of more trades, even though they're going to be small trades. All right, you get to catch those moves that only move to the 38%. Okay, so if price retraces to the 38% fib and then moves back down to retest the low or breaks the low, at that point you want to go ahead and move your target to the 162% extension. Okay, what this does is this helps to improve the reward to risk ratio. And normally, if a divergence setup can only manage a 38% Fibonacci retracement, it's going to be a stronger move anyway. Okay, so the probability is that if it can only manage a 38% retracement, that it's going to move to the 162% extension. Now, if price does trigger your orders at the 50 and 62%, keep your trade target at the 127. Let's take a look at a chart here and see how it would work. All right, now obviously this isn't for everybody. This is, a lot more detailed. It takes a lot more placing orders, a lot more order management. So here is our divergence. We have price moving higher, MACD cycling lower. Okay, here's our qualified leg. Okay, price, nice strong move below the low point of the swings. And here is our pullback. All right, and you can see, and what I'm going to do is I'm going to put the 38% on here and take off the 79%. Here you can see we retraced. In this situation, we retraced 38%, didn't quite make the 50. But here's what we would do. We would place, all right, well, actually, let me back up. All right, first of all, the very first thing we would do, we would measure from this 50%, because this is what this will give you an average position. Okay, so you measure from the 50% to above the high. All right, so you know the number of your stop loss. You know how large your stop loss has to be. And then you take that, so you know what your order size can be. Okay, your stop loss size, according to your account capital, you know how large you can trade to stay within our 1% risk guideline. And then what you want to do is you're going to take that order, that number, whatever those lots are, and divide it by 3. Then you're going to place your sell order, your first sell order, 1/3 of that number there, your second sell order, and your third sell order. Okay, these are all limit orders. And you see what happens here when the market rallies, it brings in this sell order. Okay, so you have 1/3 of a position. It didn't reach the second order. All right, so now price moves and breaks the low. Price moves down here and breaks the low. So you want to change your target. Once price comes down and breaks this low, you want to change your target. And this looked pretty volatile, so I don't know if you had time, but once price comes and tests this low, okay, and breaks this low, you want to move your target to the 162 if you only retrace 38%. Okay, because that's going to sort out your reward to risk. Okay, because if you're entering at a 38%, you're not really getting a good reward to risk above the high and targeting the 127. Okay, if you're only trading from this level, from the 38%, if price breaks this low, you want to go ahead and move your target to the 1618. Okay, and that's going to that rule is going to fix your reward to risk over the course of all the trades. So now you can see we hit 127, pulled back, and then we indeed moved down to the 162. And that is the stacked limit order entry method for our divergent setup. Okay, so basically, if you want to get into more trades, even the trades that only retrace 38%, this is a way to do it, being a little more conservative and also being able to have a decent reward to risk on your trades. Now, there are times when I will use this method, but I will use it more on the higher degree time frame patterns. I won't use it on the smaller degree time frame patterns. Okay, so you'll see me use this potentially on 4-hour setups, maybe daily setups, and that type of thing. But I won't use it on the intraday time frames or the short-term time frames, such as the 15-minute or the 5-minute charts. And that brings us to the end of the stacked limit order entry method, and it also brings us to the end of our divergence trading course. But fortunately, this won't be the end of our time together. We'll have the follow-up service, which I think is even more beneficial, being able to see this method applied, this methodology applied to the real market. Okay, and I think that's when people really learn the power of this methodology. We'll show you a lot of sim trades. We're going to show you, some live trades and things like that. But you just can't beat seeing it in a live market, because you get everything that happens in a live market. You get the good trades, you get the bad. I don't want to say good and bad. You get the profitable trades, you get the trades that get stopped out. Okay, so you don't get this tunnel vision of just winning trades all the time, because we talked about this earlier in the course. There will be losses. There will certainly be losses. We're showing you things in a classroom type of a setting. I try to keep this as close to what you're going to get in the real market, the majority of the time as possible. But in order for me to show you how the setup works, I have to show you the setups that actually do work out. Okay, so obviously there's going to be setups that don't work out, and that's what you get. You get that real experience in the next part of this, which is our follow-up service.